Welcome everyone to Investing for Generational Wealth. Let us dive into the world of expert financial insights and strategies. Before we begin, a quick disclaimer: we are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before beginning investments. I'm your host, Keshav Kolor, and I'm joined by my co-host, John Lai. And welcome to today's episode. Is commercial retail real estate dead? Today's guest is Michael J. Flight. Michael Flight is the driving force behind Invest on Main, IOM.ai, the futures real estate and alternative asset marketplace, and AcceleratedLaw, an innovative, cost-effective way to create and tokenize securities offerings. Beyond his impressive ventures, Michael co-hosts the Nothing But Net Triple Net Show podcast, educating audiences about triple net lease properties. His expertise has earned him recognition on platforms like CNBC, Real Vision, CEO Magazine, Yahoo Finance, and more. Michael has been dubbed the Godfather of blockchain real estate by Forbes Crypto and is a 30-year veteran in real estate, known for his pioneering work in real estate tokenization, and is the founder of the Blockchain Real Estate Summit and co-founder of Liberty Real Estate Fund. We'll bring him back to talk about some of that other exciting stuff, especially the real estate investing through net lease property security tokens. Thank you for being here with us, Michael. And we gave a bit of your background on your experiences, and I definitely didn't do it, enough justice. So what else would you like to add to your background and how you got to where you are today?
Well, I started in real estate in 1986. I started out I was in real estate before that. While I was in college, I was rehabbing apartments for a local investor here in Chicago. I got my broker's license, and I was a retail real estate broker, and then worked for a larger syndicator towards the end of the 80s. They had about 270 shopping centers nationwide. Then the first crash happened, 1990, savings and loan crisis. We have partnered with a lot of institutional investors, everything from hedge funds, Dutch Pension Fund Consortium, that was a publicly traded entity, REITs, everything, you name it. We were some of the first people, or actually the first, organization to do what's called demalling. So we took an enclosed mall and turned it into more of a hybrid or a strip center. So that's, some of the stuff we've been doing. I have been working with value add shopping centers, for, most of my career now. And we still do that. And then what my new favorite is, but it's always been kind of my favorite, is the really super stable triple net single tenant leases guaranteed by usually public corporations or very strong credit worthy tenants.
Okay, definitely a lot to unpack there, but yeah, today we'll be focusing mostly on retail real estate. And it sounds like there'll be a part 2, part 3, where you'll be joining us again to talk about some of the other topics. Okay. So let's get started with, if you could just define what retail real estate is. Like, what is it? What is it not?
Retail real estate is basically where people do their shopping. So, and that also includes eating. So you would also include stuff for, getting your car fixed, a lot of things. There's a new section that's really come out. It wasn't really that much of a thing when I was starting out, but it's also medtail, so medical retail, because a lot of medical service providers are finding out that they also want high quality locations, and basically retail thrives on traffic. You either need foot traffic, you need, population densities, and you need car traffic. You need cars driving by, the place. And so retail real estate encompasses everything from very small, kiosk like your water place, or even, a lot of places have like a cell tower on them because the cell towers want the location, all the way up to super regional malls, and very large lifestyle centers that have a combination of residential and commercial in them. And some of the highest rents in the world are paid out of retail real estate.
Interesting. Okay. And where have you seen, how was retail real estate doing before the pandemic? And obviously the pandemic changed a lot of things. How has retail real estate been doing since?
Retail real estate was starting to be stressed back in 2016 or 2017. There was a really big concern, and we kind of saw it coming, in 2016, that online sales were picking up and were starting to take a bite out of retail. So we started, focusing on the types of shopping centers that were not going to be affected by things that could easily be sold online. But there was also a large stress in the retail real estate market around that time too, because people's shopping patterns had changed. So there was a ton of excess space through the 80s and 90s and early 2000s. There was just a super huge amount of build out. A lot of that build out was driven by the tenants themselves, because the tenants show income growth the more stores they expand. So they have to keep expanding stores to show growth. So a lot of that, and then, there was just ruinous competition. So a lot of those tenants went into bankruptcy because they didn't have the type of market fit. And then the other thing is that you saw probably it started coming in the early 2000s and then really became a thing. Walmart started doing super centers. And once Walmart started doing super centers,
Hey, Michael, are you still there? Kishav?
You're lagging out, John.
Oh, okay. So it's me. Sorry about that.
There you are. So with that, it really crushed some of the competition, like the department stores, like Kmart. And also they brought a lot of the stuff in that was traditionally sold in a regular strip center inside. So they, cut out a lot of shoe stores, a lot of clothing stores. So the super centers really changed the way people shop as well. And then the other thing that's, been growing, a super amount is Costco. Costco has really changed the way people shop. So with that, but I always explain to people, retail has been changing, since it was the inception. There was always like the, regular county seat store, the Main Street store in the small town that was disrupted by Sears, in Montgomery Ward's catalog. Then, chain stores started. And so retail has constantly been evolving, and it will continue to evolve. Now, retail is more focused on food, convenience, and, entertainment experience, or as we like to say, treasure hunt type of retailers. And what do I mean by treasure hunt type of retailers? If you go to Costco, Costco is kind of a treasure hunt retailer because about 20% of their store always has something changing in it. So people constantly go to get the staples, but they also go there because you just find these like great deals. Well, the treasure hunt store, one of the most successful retailers out there is, Marshall's and TJ Maxx, and they're both owned by the same company. And it's the same thing. People go there. There's constantly changing merchandise. You go there, you get new stuff. And so TJ Maxx has been extremely successful. And to give you an idea of the lineage, TJ Maxx originally started out from a department store and then a discount department store, which was called Zayre's. They completely got rid of the Zayre's department stores, and now they're one of the most successful retailers in the country, especially for clothing. So with that, hopefully that answers a little bit about.
And I guess, how did the pandemic change the landscape of retail, or did it just further exacerbate those trends that were already coming?
Well, the pandemic really exacerbated some of the trends, and a lot of the stuff went online. But since the pandemic, a lot of that stuff has returned to normal. So Amazon's share of sales has gone down. Amazon still hasn't figured out how to do physical retailing well. So they're still trying to figure that out. And honestly, right now, it really affected retail during the pandemic because we had probably in some of our shopping centers half of the tenants closed, forcibly. So there was certain retailers that figured out, especially restaurants, that figured out, well, I need to have a drive-through because most people want to drive through. So you see Steak Shack, or is it Shake Shack, adding drive-throughs to their stuff. Everybody that didn't have a drive-through before is now doing pickup, and delivery, and also trying to put in a drive-through. Even your, sit-down restaurants like Chili's, and, they've focused a lot more on to-go. And so that's kind of changed things. But the other thing is that the tenants that did come out the other end of the pandemic are much stronger. So right now, we were concerned about the amount of vacancy before the pandemic. Right now, most of our stuff is close to 100% leased, if not 100% leased. There is a really tight market out there for quality retail space. If it's crummy retail space, it's not going to be leased. But if it's quality retail space in the location that retailers want, it's hard for tenants to expand right now.
Do you find that a lot of tenants, or there is a tenant base that is providing experiential type retail experiences? I mean, I'm thinking of the like bowling sites, gaming sites, maybe the arcades that are coming back. I don't know. I hear a lot about consumers flocking to experiences, right, and spending money on experiences versus on just goods.
Right. Well, that's a lot of the retail space has been soaked up by experiential retailers. So the thing that you would never see in most shopping centers 10 years ago was a gym or a health club, because they just take up a bunch of parking, and a lot of times those people don't go shopping. Most retailers have relaxed their restrictions around having a health club in, and so health clubs and gyms are one of the major anchor tenants now out there. The other thing that you see, I'm kind of concerned. I would probably and don't quote me on this, but I probably wouldn't buy a shopping center with an anchor tenant as a trampoline park, because I don't know how those guys make money, and it really doesn't add any value to your shopping center. If you want value to your shopping center, a great experiential tenant would be like a Chuck E. Cheese, which brings like the whole family in. And so if you're a dad and your wife is there, you can just go and then kind of leave and go someplace else. Or, if you're a dad like me, I would say, why don't you go shopping and I'll watch the kids here? So I didn't do Chuck E. Cheese that often, but when I did. So those things do drive sales for other tenants. So you have to be concerned about merchandising. Does somebody come in and buy stuff from other stores? Because that's the whole point about a shopping center. If you've got a single tenant, retail tenant, you don't really need to worry about that as much unless they are in a shopping center. And then you need to know what type of demand is being driven behind them.
Are flagship centers still a thing within malls? Like you have a flagship store or maybe a couple of anchor stores within a large shopping mall?
Yeah. So what we really like is grocery anchored centers because people will tend to go to other places. I don't mind a Target and Target provides more cross shopping than a Walmart. A Walmart seems to be like a vacuum where people go in and it vacuums all the money out of their pocket and then they leave. So, that is not as great of a cross shop. And then, we've had negotiations with Costco and I respect them, as a retailer, but they're not a great, anchor tenant because people, have these giant, baskets full of stuff and everything. So if they go to Costco, they buy everything and then they're not, going and cross shopping. And I'm going to put Keshab on the spot and ask him what the highest selling brand in the world is.
Revenue or like price per item?
Revenue.
I would guess luxury, like a Louis Vuitton or one of those brands.
I'm talking gross revenue. In terms of gross revenue, the Kirkland private label brand actually outsells Nike in terms of gross sales. So that's the type of power that these guys have. The other thing is that one of the actual largest gross revenue corporation in the world is Walmart. And they actually employ, I think, close to 20,000 people. They employ more people than the U.S. federal government. So these are massive things. And then the other really cool thing about Walmart is Walmart was always a logistics and technology company, first, because they figured out how to get the stuff there and get it to local demand. And they've actually dialed in way more than Amazon. So Amazon really hasn't figured out how to, personalize each thing. Because where I live, there could be a Hispanic area, there could be, a different area, there could be an Asian area. And, Walmart knows how to market to those individual things because they just keep track of so much data. So anyway, that's, we could probably move on off of Walmart and Costco and Target.
I had a question on the model. So triple net, is it triple net pretty much the standard across all commercial retail, or are there other models, business models that people employ?
Well, let's define what triple net is. So triple net is where the tenants pay the taxes, insurance, and maintenance. So we like to use the acronym TIM, taxes, insurance, and maintenance. And if it's a single net, the tenant pays for the taxes. If it's a double net, the tenant pays for the taxes and insurance. And if it's a triple net, they pay for the taxes, insurance, and maintenance. There's a little bit of a difference. Even though people call shopping centers triple net, they're not quite 100% triple net, because in most shopping centers, the landlord has to maintain the roof and the structure, but everything else, the tenant pays for the parking lot, the tenant pays for, sweeping of the sidewalks, the tenant pays for snow removal. So that's part of the net charges. And in a shopping center, we just divide those up by the square footage of what they occupy. And so they pay their percentage of that. In a single tenant triple net lease, most of the time, if it is a real triple net lease, the tenant will not only pay taxes, insurance, and the ongoing maintenance and, snow plowing and all the rest of that, but they will also be responsible for maintaining the building, the roof, and the HVAC. So you have to be careful because some of those dollar store leases, a lot of the brokers will say it's a triple net lease, but it's not a triple net lease because you're responsible for the building and the roof.
Single tenant versus like multi-tenant, which one do you prefer? Which one's like a more stable and which one brings in the consistent revenue, the lowest churn?
You can get more upside with a shopping center. So you can get value add versus on a single tenant lease, the lease is usually locked in. Mm-hmm. So unless you buy a single tenant lease where there's an expiration coming up and you're confident that you can release it or the tenant's going to renew at that location, most of the time there's not going to be a tremendous amount of upside. So there's not a value add component to it. What I really do like about single tenant leases is that it's regular, consistent income. So it really doesn't matter most of the time what the economy is doing and all the rest of it. That tenant's obligated to pay, whether the economy is like dropping down or increasing. And as long as they're not going into bankruptcy, that tenant's going to be there. So what we used to focus a lot more on value add, and it was right around the time that we saw the retail market changing, and it was much tougher to lease a shopping center, and the tenants weren't quite the credit quality that we were used to. And so then I said, well, we already got these out parcels and we're already doing these single tenant leases, and we had already bought portfolios of single tenant, bank buildings and things like that. And so it's like, this is much more consistent income. It's a lot less work. And in most cases on a national tenant, you get an ACH payment directly to your bank account like 5 days before the beginning of the month. I mean, for those of you out there that are doing, multifamily, that's like the ultimate. And then, when the tenant, like the HVAC goes out, and if the tenant calls you up and says, oh, my HVAC went out, can you send somebody out? That's when I say, did you look at your lease? Because you're responsible for this. Mm-hmm. So what we like to say is triple net is, no taxes, no termites, and no trash.
So someone who's like new coming into this space, like if they were just brought a retail opportunity, walk us through your thought process of how you would judge if it's a good opportunity or not.
Well, it both from a multi-tenant shopping center and from a single tenant, the first thing I always look at is the location. And so can you get in and out of it easy? Is there other retailers around it? Because retailers are like lemmings. They want to see like retail density for the most part. And the other thing I like to see is there visibility? So there's certain areas where it's really great incomes. Like if you go down to I think it's Myrtle Beach, one of those areas down there, there is super high incomes and pretty good population density, but the municipality made them build it out so that there's like a row of trees in front of every shopping center, so you cannot see the tenants there. So when you didn't have GPS, you wouldn't even know that the tenant was there. So that it's very important for visibility. Then I like to see, is the tenant or tenants in the shopping center something that's going to be recession proof, something that's going to be internet proof. And what we also found out is that if they're internet resistant, they're also pandemic resistant. So is there a need for somebody to go there on a daily, weekly, or monthly basis? So that's why we like, traffic drivers, like, dollar stores. We like, discount department stores. We like, anything with a grocery component. We love stuff with restaurants in it. You just have to be careful with restaurants because they do take up a lot of parking. And the same thing, We've got a few grocery stores that are just hitting it out of the ballpark. And it's a good problem to have, but there's almost no parking in the shopping center because the grocery stores are doing so well. So, but, I'll take that versus the grocery store not doing well and closing. So we've had those too. But so location is first. We also like to see the credit quality of the tenants, because that's going to be dependent on what type of financing you can get, especially with a single tenant net lease property. You could potentially get 100% financing if it's a AAA credit. So we actually did a deal with a Jiffy Lube. We didn't know at the time, but there was a franchisee in there, but the lease was guaranteed by Shell. And so I almost would rather have Shell Oil Company on the lease than even the United States government, because I'm pretty sure that oil is going to be around for a little bit of time, and those guys are making bank on cash flow, especially they're going to be making real big money the next few years. So that's the type of thing. And with that, we got close to 90% financing on that. And then the bank said, well, we'd like you to personally guarantee this. And I'm like, I'm not going to personally guarantee this because you're going to look to Shell to pay this, not me. If Shell can't pay this, then we're in a really bad spot.
Yeah.
Do you foresee like any market dynamics that would be bad for commercial retail in the near future? I mean, everyone's been talking about recessions, for the longest time. It hasn't come. But assuming that there's like this downturn, obviously people are going to cut back. But is commercial retail, I guess, recession-proof, or how recession-proof is that?
It really depends on the tenant. So what's been surprising is the luxury tenants have been recession resistant, because people that are earning a lot of money really most of the time don't feel the pain and can afford to pay more for things. So over the past few recessions, luxury tenants haven't really felt it that much. And then the other thing is necessity tenants don't feel the recession as much. If you look at auto service, if you look at medical, if you look at people aren't going to stop buying groceries. They're going to shop more for groceries. So one of my favorite tenants is Aldi. And I really actually, when Aldi came out and they started their penetration in the United States here in Illinois, and they were just a junk retailer. You went in and they had just boxes on the floor and everything else. But you go into an Aldi now and it's just got amazing stuff in there, a lot of stuff from Germany and everything else. But you can also, in my area, get eggs for like 99 cents, a dozen. And so you're going to see a ton of people flocking to Aldi, especially in the lower areas, but also Aldi has been, doing very well in upper income areas as well. So that's the type of tenants that are going to do well. Dollar stores are going to do really well. From the past recessions that we've seen, TJ Maxx, Marshalls, Ross, those guys do really well because people start, pinching their pennies. Where you're going to see, tenants like women's fashion, some of the other things that are, sporting goods and things like that, there's going to be some cutbacks. So there's going to be some pain. I don't think there's going to be as huge of a fallout, in the bedding stores and things like that, because, Bed Bath & Beyond and those guys have already gone out of business. So I think that a lot of the tenants that went out of business are out of business. I go back to my trampoline park example. I would be very concerned if I had one of those during a recession, because, that's probably going to be the first thing. Or, I'd be very concerned if there's an axe throwing thing or some of the other, like the escape room and things like that absorbed a lot of retail space. the retailers that have a good brand name and that do well in both recession and out of recession, I think they're going to do well. And honestly, it's going to be hard to tell because there's been so many retailers over the past 10 years that have really just disappeared from the face of the earth. I think that the culling has happened. You might see there's a few tenants that are on the bubble, but I think they're going to make it through. We, Party City was in bankruptcy last year. We renegotiated a few of the leases that we had with them. And I think they're going to make it through this time. They've gotten rid of a lot of debt, but that would be a concern of mine because I don't know, how much people are going to be, buying balloons and stuff. The stores that I really like are pet stores because I think people are going to give so you might see a lot less travel. You might see a lot of things. But I think people are going to spoil their pets like they spoil their kids. So I think that's going to be pretty good, but we'll see.
Interesting. What are typical returns that, an LP could expect when they're investing in retail real estate opportunities, syndication opportunities?
That really depends on, again, the type of deal that it is. If it's a value add deal, we've had, and it really, right now we're in a different financing market too. But you're going to get higher returns from a multi-tenant shopping center, and you're going to get lower returns, but you're going to get safer returns from a triple net deal. So if you look at some of the triple net deals that we're looking at right now, they're anywhere from 7 to 8 caps. And if you put some leverage on it, we can get returns right around 9 to 9.5%. But those are real returns, and those are returns from the start. It's not like some of the multifamily deals that I see out there where the sponsor is over raising and saying, I'm paying a 10% preferred return. But there's actually no cash flow. And then, at the end of year 3, they're like, oh, well, we don't have any more money to pay this. So, those are real returns. They're, the return that you get out of the box. Some of the deals that I really like in triple net deals are the automotive and the medical, because a lot of those have built-in increases every year. So they increase anywhere from 1.5% to 3% per year. So your returns start kicking up every year. So those are really nice. And like I said, they are super conservative returns because, number one, we like to say it's cash flow from the get-go. And then, like I say, you can get higher returns, but with the shopping center, there's also a lot of capital involved. So we were just looking at a deal in Orlando, and our partners have it tied up. And one of the things is that there's 6,000 square foot vacancy, and so we were going through, and they were looking at, because they said, well, we typically do like 3% CapEx, and we do this type of reserve, so we overraise for the reserve. And I'm like, well, on this one, you don't have to, because they're like, they're multifamily guys. And I'm like, we don't have to, reserve for the roof, because on the leases here, we can charge the roof back to the tenants. We don't have to reserve for the parking lot, because on the leases here, we can, charge back to the tenants. So the main thing that we have to reserve for is when a tenant does go out, it's typically pretty capital intensive because you have to basically build them a new space. In a new space, typically stores are leased as white boxes, which is drop ceiling, drywall, ready to accept paint and all the rest of that stuff. But most national tenants want, more than that. So they want you to either build it out, or what we prefer to do is give them cash or free rent and say, you take the risk on construction. And we cap our risk on how much we'd have to pay to build it out.
would that still be a value add deal where a tenant's coming in and out, or is that more of like a, I don't want to call it development, but is
It's
that
not
that'll be called?
development. It's not development. It's actually just, regular operations. It's value add. The reason why we would buy them is because we know that we can increase the leases, or we can get better tenants in there that would be able to get us a better financing. So, leasing, the part of shopping centers where your value add is, or even in single tenant, is, your leasing. So the key thing is that if you don't know somebody that has the relationships with retailers and knows how to negotiate a retail lease, you should find, a quality broker or somebody that can help you do the leasing. And then you really definitely need an attorney that knows how to do a retail lease. My attorney, I've been working with him. I forget now. I think we first started working together when he was at a different firm. But I think we started working together in like 1994, 95. So, and I was telling my partners, I'm like, we're going to use my attorney on all the lease negotiations, because he knows, and he was trained by my mentor, that he doesn't negotiate all the stupid stuff like, condemnation and things like that to drive up the price of, legal bills. It's like, these are the things I want you to focus on and nothing else. So, and I realized that I had made it in terms of, knowing about, leasing, and, knowing when my attorney calls me up for advice sometimes on, he's doing a, deal with somebody else and says, hey, what would you do and how would you structure this? So
That's the dream.
or it's you've been in it too long.
Yeah. Okay. We are coming up on time here, so I'd love to transition over to our questions that we love to ask every panelist. So starting off, what are some failures you've had along the way, and what have you learned from those failures?
I have had a ton of failures, and we've made a ton of mistakes. So when we are typically working with a private equity firm or an institutional investor that's looking to come in with us, I always start out and say, I haven't had everything bad happen to us, but we've had a whole lot of bad things happen to us that, we're not going to panic. And we have a pretty good network around the country that we believe we can deal with almost any problem. I have had, issues, and one of my biggest failures is we were flipping houses. A partner and I, who's a residential broker, we were flipping houses, and we had a contractor, and I trusted the contractor too much. So, and we had institutional investor, investors that were our partners, and we had gotten way ahead of paying him, and he actually didn't do the stuff. So on that one, I had to come out of pocket a lot of money to make that whole, because my partner had no money. And it wasn't the institutional investor's fault. So that was next time, whenever, and that's why I say construction risk. I'm very concerned about construction risk. But we definitely don't pay anything, anymore unless we see that the actual work has been done. So, and if you are not familiar with construction or anything like that, your best bet when you do have a construction project or a development project is have a title company make the payments, and have the architect, if it's a bigger project, have the architect have to sign off and say, yes, this progress payment should be made, in that. So that's one of the bigger. We've also had, issues where, there's environmental problems. It's not necessarily a failure, but, even when we had all the, inspections and everything else, it turns out that there's underground storage tanks, and there's literally, there was so much oil under this one property because there was a Sears Automotive Center underneath there, and you would think that they would have noticed that when they were emptying the tanks every month, that for the oil change, that there was nothing left in it. But there's like a lake underneath this property, so that was close to $300,000 to get remediated and everything else. And I just said, well, why can't we just bring out a pump here and get it up, and we struck oil. So, but that didn't really add value. It just was a negative. So, and then the other, so environmental problems have been there's always a situation where you need to be concerned if there was a dry cleaner too at a shopping center, or if there was a gas station on the corner. So those are those were the worst things. What were some of the other failures? There's been a few of them. I mean, what one of the failures was doing a lease with a tenant that we were really tight on money, and I really needed the tenant bad, and I was on the brink, and so we ended up doing a really bad deal with a tenant, and some of these deals. So this particular deal was a 20-year term, plus a string of 10-year options, and so we're living with that bad deal today. So and having had centers for some of them since 1990, you really learn what eating your own cooking means.
Gotcha. And so second, if someone who's starting out in this space, like it's their first investment or second investment into retail real estate, what's some things that they should be wary of, or like what's the greatest like fallacy or falsehood that you could debunk for them right now?
In the single tenant triple net space, everybody always tells you that it's all about the tenant and the tenant credit, and that's the biggest fallacy, because the biggest thing that you want to make sure is that it's a good location. It really doesn't matter what the credit is. If it's a bad location, the tenant's gonna shut it down. And I'll give you a good example. We had a Meijer store, which is based out of Michigan. They're one of the largest private companies in the United States. They are a fantastic merchant. We ended up doing a 25-year lease with them. There was a string of issues, especially with the county. And so they ended up closing the store after 4 years. But the key thing is that it really doesn't matter how good of a tenant they are and how great of a credit they are. If they can't do business there, they're going to close the store. So we really made out on that one, because they put $12 million into a building and they built it out wonderfully. And we ended up buying it back from them for $2 million. And we got a grocery store to pick up 70% of the space, and they paid 70% of the $2 million. So we ended up owning a $12 million building for $500,000.
Not a bad deal.
Yeah. And the grocer is doing 3 times the volume that out of a smaller space. So it's all about knowing your market.
And lastly, how do you give back to your community?
There's a few things. I am done giving back to my community. I was elected to a few different boards in my community, and I'm full-time not doing that anymore. So somebody else can do that, somebody younger. I just happened to last night, I'm on the real estate board for a great private high school here in Chicago called Chicago Hope Academy. And I'm on the real estate board. And over the past, I think 8 years, we've done, through house flipping, have, given the school annually between $500,000 and $1.5 million per year in operating capital. And I've been honored to be the guys that run that are fantastic. And I've just been honored to be able to, hook them up with lines of credit, through my resources, say, maybe you should do it this way. So we just had one of our last meetings because that's going to be wound down next year. And then I've also done for another ministry on the south side of Chicago. We've rehabbed and redid neighborhoods, through that stuff. And then one of the other things, through people that I worked with, I met them on Upwork, and she was doing work for us, and she still is, for websites, but we got them more website training. And she started in Romania, which now is expanded to countries in Eastern Europe, women who were trafficked, and it's a thing to get them out of being trafficked and into online jobs, either VA or stuff like that. So that was something that actually a community organizer in Chicago, said to me, it's like, you're a business guy, why don't you help these people? I don't know anything about business in Romania, but I figured it out. I'm like, okay, we could get them into, Amazon affiliate marketing. We could get them into all kinds of businesses that they can do out of their home. So
yeah,
that's some of the stuff I like doing.
Definitely a wide variety. So that's great to hear. So with that, just want to say thank you very much for a great chat about retail real estate, Michael. To learn more about investing in commercial real estate, feel free to reach out to Michael on LinkedIn. We'll include his contact information in the description for this podcast episode also. Thank you for educating us on investing in retail real estate. We learned a lot about how these these leases are structured, right? Single net, double net, triple net leases, why retail is not going anywhere anytime soon, and what to look for in good, retail investment opportunities.
And if they want more information, I'm sorry to interrupt you, Keshav, but if they want more information, they can go to our website, libertyfund.io. There's a bunch of articles on there on investing in triple net properties. They can also download a report there that explains, why it's good. I'm currently working on a ebook. So if they want more information on that. And then, like I said, we also have the Nothing But Net podcast, which we structured it. So it's like, if you're a beginner, what do you look at, all the way to, doing things from an expert level.
Gotcha. Okay. Yeah, that's definitely a plethora of resources. So we'll include that in the description also. And so again, thank you for taking the time out of your busy schedule to speak to our audience. And for those listening, don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. And until next time, keep learning to invest for generational wealth.
Thank you, guys.
Great. Thanks, Michael.